All right, guys. Hello, everyone. I hope you guys are fine. Um, we are dealing with donations tax and estate queuing, of course, at advanced taxation level. These are the legislative framework that you should be familiar with when dealing with donations tax and also the state duty. So you've got to understand what is donations tax, why donations tax is levied, all those things. So this is just the legislation, some sections relevant. So then you've got the very important question of what is donations tax? If you ask me this question, actually it's a very relevant question. So any transfer, any tax on transfer of assets, which is not really a tax on income. As they say, it is a form of wealth tax. What does that even mean? Because it means if you are transferring something to someone else, it actually means, you've got more, you see. So it's actually levied at 20% of the value of donations, of course, the extent of the donation. So, but if anything, is actually more than 30 million, then it goes to 25%. So these are just definitions that are very important and actually very relevant, for your understanding. So, for example, donation, they say it's a gratuitous disposal of property, including any gratuitous waiver or renunciation of a right. So if you renounce a right to receive a property that's deemed as a donation, then you've got to have a donee. So that's actually a person that actually gets, what you are donating to. Then you've got the donor, but when you specific about the fair market value, what is it exactly? Any price at arm's length, maybe perhaps in an open market. You see, but for immovable property, which is farming, we always use 75%. So what is a property? When they refer to a property, they don't only speak to immovables. They speak to both movables and immovables, and also, corporeal and incorporeal, whosoever actually, is situated. But Section 53 actually states that donation is deemed to take effect on the date in which all legal formalities have been complied with. For example, the offer and acceptance. Say, for example, now you people, you're quite generous people. So you are saying, no, look, Mr. Pesa, we are donating, to you this property. Say you people, of course, we had a lot of properties. Now you're giving this to me. You see, saying, you say you are such a good lecturer, just get this property. So at an event then that I accept that offer, then where all legalities have been, complied with, say, for example, now the price has been registered on my name. Now I'm this happy lecturer. So that's what's it's kind of an example when they mean formalities. Then we go on to say then donations tax. If we are specific to section 54 actually, so it's payable on the value of property. It's very, very important. So it's payable on that. 57 state that if it's disposed by a company at an instance of a person, then that person is supposed to pay the donations tax. Let's make an example here. Let's say you people have a company. You call your company advanced taxation, company, PTY Ltd, that's fine. But at an instance of you people, the company is making a donation. So the donations, according to this section, it will be deemed to have been done by you people, not actually the company, because it is in your instance. So 58 then 7 capital A state that if donation is made by a spouse married in commune of property, you see, is actually deemed to be made by two of you. You see, yes, if it's made by income of property, if you are a married person, now you are making a donation. You see, yes. Then there is, of course, your 58 deals with the deeming provision. You see, yes. So what happens? So if a property is disposed, of course, for construction, which is not considered to be adequate, what does this even mean? Remember, I might donate the property for this value, perhaps maybe the market value. Maybe I'm selling a property for 50 million, but the property actually is actually 70 million. So if it's actually found out by the SARS, the commissioner, that then the difference between that will actually be the shares or maybe actually the donations. We put an example of here of Mr. Generous sells his property 750,000 market value just for 50,000. Look at that. What's that? The whole donation of 700,000 in this regard, because that value is not deemed to be, adequate value. All right, limited interest. So when we deal with limited interest, then is when we deal with, within a property, there is limited interest. There is a split actually. So and so has this right, and so has this right. So the most most popular rights is a factual rights. Then we've got also the bare dominion. So the usufruct, of course, you are the person that actually using a usufruct. You are called the usufructuary. Then you have a right to use the property, but not to own the property. You can receive income in this property, you can do anything but not to own it. Whereas we've got a bare dominions, I mean, this person in this case has a right in this case of ownership, but not the use. Now you've got two kinds of people here within the same property with different, rights within this property. One example I usually give when I speak about this is whereby you've got two kids, say as a parent, but these other kids like to sell everything. Actually, everything they have, they sell. They've had their cell phones, they sell everything. So you say, okay, look, these guys, they are not responsible enough. This guy actually is not responsible enough. So what happens? We'll have the right of use, but not ownership. Then this one is responsible enough, but is well off. You see, for example, has his home, owns his own thing, but now we give that person the right to own, this one the right to use. Now, whatever happens, they will never sell the property. This is not so responsible son of yours. So this is actually, as you can see here, where we talk about usufruct and bare dominion. We have an example of Mr. Rich, he holds a bare dominion, whereas Mr. Richie Rich, this side, the son holds a usufruct. What does it mean? Richie can use the property, can earn income, anything happen, but does not own it, cannot sell it. However, Mr. Rich this time around owns the property. Yes. So this can apply actually, in every property. It can be fixed or even movable property. Okay, let's get to talk about the donation of a usufruct. Bare dominion, guys, please yourselves. He's now talking. Ngoni is talking. Okay. Let's get to understand, guys. We've got some example here. Mr. X donates the usufruct in his house to his brother, Mr. Y, and donates the bare dominion in the house to his son, Mr. Z. Now you can see here, there are two individuals, they have different rights. Another one has a right to use, another one is a right of ownership. Mr. X donations must be valued, and donations, tax will be paid on it, and also Mr. Y, which is the usufruct, must also be valued. So Z, of course, then in this case, Z also holds a bare dominion, but has no right of use on income in this case. So if Mr. Y dies before Z becomes entitled to the use of property and an income from the house. That's what happens. Those will be random. But if Z dies before, then the Y, the pay will go on his hairs, in his hairs, in terms of his will. That's what happens. All right. We carry on with limited interest, good people. So what happens then to a fiduciary, a fiduciary interest? You see, yes. So
Hi.
a fiduciary interest where in a property.
Hello.
Hello? Is someone saying something? Maybe not real. Okay. Okay, that's fine. Okay, let's carry on, guys. Okay, then a fiduciary interest is also called a fiducium is limited interest in a property. Also, this is where you've got a first person donates or leave a property to a fiduciary, which is a second person, on a condition that when that person dies, it will pass on. Say, for example, the example I have, I'm saying, no, look, my guy, you are my son, I'm giving you this property, but when you die, it will pass on to your son, maybe to your daughter, to my grandson or my granddaughter. You see, that's what happens. Now you've got the first person who leaves the property to the second one, but the second one will have to leave that property to the next. You see, then the fiduciary then does not own the property, full property, remember, because they need to leave it to someone else. So they are entitled to the use, but they cannot dispose the property, and they can become full owner of the property only if fiduciary commercial dies before the fiduciary. Now, can you see, it's what I always say now from our background, that, you'll see people killing one another now if you know that if so-and-so dies, I've got the right of this property. All right. So we talk about the donations tax of the fiduciary interest. So Mr. X, for example, donates a house to his brother, Mr. Y, on condition that on Mr. Y's death, ownership will pass to Mr. Z's sons. This is another example of fiduciary. So Mr. X then has donated the fiduciary interest to Mr. Y. The donation amount must be valued and donation tax will be paid on that. And also Mr. Y has a full use of property for as long as he lives, but may not dispose it. That's what becomes clear. You see, yes, and Z has no entitlement in the property until Mr. Y dies. You see what I mean? So when Mr. Y dies, Z then becomes the owner. Now, can you see that Z may have all the motive whatsoever to kill Mr. Y because he knows immediately will become a millionaire. So if Mr. Z dies before Mr. Y, Mr. Y will become full owner. Now, you can see also the uncle can also kill what? The son, you see, of his brother. Because now the uncle says that if I kill this kid, I may, be a millionaire or become the property owner. See, yes. So to some extent, these tax, things can actually, promote, those, killings amongst family members. So in taxation, actually, we speak about, tax, we speak about donations tax, then there are exemptions. And in these exemptions, there are two types. We've got specific exemptions, and we also have general exemptions. For example, 56 to 56(2)(c). So one actually state that where you donate something to your spouse in respect of an antenuptial contract or postnuptial contract, that donation will be exempt in terms of this 56(a). Secondly, donation to a spouse not separated from the donor. What if the spouse is still not separated from the donor? That donation will also be exempt. So what does it mean? It means you will have to calculate donations tax first, then you will state that it's actually exempt, then you've got nil. You do not make a mistake of saying the spouse is exempt. You explain like that. You don't do that. You actually compute the calculations, and after computing calculations is where we'll be able now to see whether we've got zero, and this zero is due to exemptions. Donation under which benefit only passes to the donor on the death of a donor, where I'm like, no, look, my guy, when I die, you will get this property. So that's actually exempt under D. So a donation cancelled within 6 months of the date. So also this one is actually exempt donation. If a donation made by a ternary or traditional council, it's either made by two or any of the transitional councils. Say, for example, I'm saying, no, look, man, I know Mrs. Zulu, the king of, Zulu, will actually be having, a big ceremony. I would like to donate 500,000. If, of course, I was that rich, then that donation would be exempt under these provisions. G, so donation of a property or right in property security outside the Republic. If a property was acquired by the donor before the donor became the resident, it will also be exempt, or maybe it was inherited by the donor, yes, out of the funds use of that property. Section H deals with the donation by or to any person, including government in this case, which is referred to in 10(1)(a), C capital A, or government, municipalities, city and public organizations. So if you donate anything, then it will actually be exempt in this section. Your K deals with voluntary awards if included in gross income of a donor. But now this is very specific. It must have been included, you know what I mean, in the gross income of a donor. You see, then it will then be exempt. Property disposed of in a pursuance of any trust or distribution from a trust to a beneficiary. If we've got a trust, we've done trust recently, and you people are happy or comfortable with trust. So if there is this donation for the benefit of a beneficiary to the trust, or it's a distribution, it will actually be exempt under this provision. Your M, use the donation of a property other than usufruct, bare dominion, or other likes interest to the use or occupation of farming property given to the donor's child. This is very specific now. to the donor's child, not to everyone, but to the donor's child. So what happens in a question when you have, two scenarios where it's a son and, an uncle, you've got to know it deals with the son, with the donor's, child. So donation by a company recognizes a public company in respect of Section 38, so it will also be exempt. You don't have to worry about your O, but your R, donation by a company to another resident company, will also be, if they are in a member of the same group, it will also be exempt. Your 56.2 then deal with bona fide contribution to maintenance of any person or community considered as reasonable. For example, payment made by parents to education. You see, like really, you don't expect the parents now to pay donations tax if they're just paying your school fees. It's actually specifically exempt under this section. Then we've got exemptions, of course, then 56.1 C and D. So what is the difference? So here we've got the difference here. We've got to understand these two. So 56.1 C actually states that a donation multi causa, which actually donation in contemplation of debt, where a donor anticipates his debt and he undertakes to donate an asset on that basis. You see, so asset will only go to the donor if the donor dies. You see, but this is revocable. It will fall away if a person doesn't die. You see, for example, now we've got Mr. A here. He decided to go skydiving and says to Mr. B, if I die when I go skydiving, you can have my speedboat. Can you see what's happening here? What if he doesn't die? The donation is revocable. Then if Mr. A dies, B will get it. If he doesn't, you see, it falls away. So it's exempt. That's a 56.1. But there's a difference, though, between 56.1C and 56.1D. 56.1D is when, where it will only pass through you when I die. So you can only get this property when I die. Now, it's not based in this condition. It's paid if when I die later on. It's not on the anticipation of death, this one, but when I finally die. That's what differs. For example, Mr. A says to be, when I die, if I can, when I die, you can have my speedboat. Now, it's not because he's going to skydiving. So it's not revocable, this one. It's different than the 56.1, 56.1C. 56.1D is actually very specific when one dies, God knows when. But 56.1C, when I die on a particular event. Look, my guy, I'm traveling to Bizana now. Can you believe it? I'll be using my old bakkie. It's not so good. If I die on the road, it's fine. You can have, this property. That's different than saying, when I die, God knows when you'll get my properties. Then we've got general exemptions. So I did tell you that we've got specific exemptions specifically for those purposes. Then we've got now this side, a general one. General ones actually are very, it remains to, for example, a casual gift for a company, a casual gift made by any donor other than national person, limited to 10,000, you can say, other than national person. So if a period of assessment is less than 12 months, then it has to be apportioned. Then you've got your 56P, 2P. So annual exemption for national person is 100,000. What does this mean? It means if you make a donation as a person, let me make an example. Say I'm making a donation of 150,000 to this, person. Okay, that's fine. That's fine. So the first thing you need to know, is there a specific exemption? You ask yourself that question. You go and look at section 56, you identify, is there a specific exemption, 56.1? Okay, that's fine. Secondly, you say, okay, it's fine. It doesn't appear there is a specific exemption. So Mr. Pesa donated actually 150,000. So the specific exemption is 0. However, what is his general exemption is 100,000 per year. So it means if that's the case, you will say 150 minus 100,000. Then the donation will be calculated based on 50,000 only. This one does not have to be apportioned, but also it's limited. It's limited to the amount donated. Say, for example, I donate 40,000 a year, but I've got an annual exclusion of 100,000. You only limit to what? To 40,000 a year. How must the general exemption be applied? The date of order. For example, now they say if I donate 10,000 today, 5,000 tomorrow, 500, you see, you've got to understand the dates. What happens? Most probably there are one donations then say taken in the same date. You see that the donor, or you can elect now if you see, you can elect to say which one comes first. These are this slide actually is just, an overview of, your exemptions. For example, you can see yes or no. You can see, for example, donation made to SPCA. It's an approved beneficiation. This will be specifically exempt in terms of your section 56(1)(h). So as you can see, the list goes on up to the donation of a property situated in Canada, which was inherited by the taxpayer from his non-residents. It will be exempt in that case. So this slide actually just gives you an overview, actually. And also, as you can see, sometimes the donation made to one's daughter on her birthday. So as you can see, is it exempt? No, it's not exempt. However, we can have annual exemption in that case. Donation of valuation. How do we value the donation? So the property, then, if you've got full ownership, so of course there might be limited interest. We just said that. We said sometimes a person owns a right to own, another one a right to use. So your 56 then 1 capital A deals with unlisted shares. They say that unlisted shares, company which owns property on which bona fide farming operations are carried out, you will have to always use, in that case, 70%. Donation to limited interest, so you don't have to worry about this, but you've got to know how it's valued. So sometimes here you've got specific provisions. So your 56 is the end of 56(4). So the commissioner may increase the fair market value taking first as a municipal valuation. If you've got a property, say for example, now I'm saying, no, this property I've donated is 100,000. The commissioner has the right to say, no, look, based on the municipal valuation, it's 150,000. So therefore, you've got to pay donations tax at 150,000, not 100,000. So the payment of a liability, section 60, is very specific. So it must be paid by the end of the month, following the month during which a donation takes effect. And also payment must be accompanied by the return. So there must be donation and you're also filing a return. So the liability is payable also by the donor. However, if there is a person, the donor fails, both the donor and the donor, they will become jointly and severally liable in case there is a failure. Section 7, so must be payable on loans or resting to a trust or common contract. So in case now there is a donation, right? For example, let's say there is a trust, so it must be paid by the donor in that case. So if maybe there is a loan made to a company where the trust hold 20% of that equity shares, then in that case, there might also be, in that case, the donations tax. So we've got other tax consequences, you see. For example, you've got your CGT consequences where your para 11 of the 8th schedule, where the donation of the asset, of course, as disposal is a capital loss or personal use asset disregarded under paragraph 53. So if you've got also your deemed disposal at market value, remember, your deemed disposal is whereby you are donating an asset. Remember, if you donate an asset, there is a donations tax. However, you go on further, as much as there is a donations tax, what happens? There is a deemed disposal. Paragraph 38 states that it's a deemed disposal. You are deemed to have sold that property at market value. Therefore, you've got to calculate, the capital gains tax. Then a portion of donations tax can be added to the base cost. Because if you add to the base cost, it means it decreases what? Your capital gains tax. The donations tax of an asset then on which the deduction allowed was claimed, resulting in deemed disposal, of course, at the market value, and also resulting in a recoupment of previously allowed deductions. It's very important. You've got to recoup that. But the donor also is deemed to acquire asset at a market value also. So meaning which they are also acquiring at the market value. So if there is an income resulting from donated amounts, then could trigger is the application of 7C deemed accruals. We've just got to understand what's going on in that amount. All right, that's all, guys, about the donations tax. So now we'll just focus on the estate duty, which is also one of the very, important, tax sections. So what happens then? What is estate duty? So thanks to, Business Dictionary, because they say a tax paid on the property left by the dead person. Now, I want you to think of a situation, because now you are a living person. Do you think you will live forever? Guys, do you think you will live forever? No, it's not happening. Somebody actually said, no matter how much we pretend we live forever, one day we'll die. But even when we die, SARS still has the money. So it still needs to be taxed. So even on your grave, even on your grave, on the mortuary, it's on the cold, on your cold corpse in the mortuary, SARS will still go after their money. So it's governed by the State Duty Act. So it's a separate act. It's like a VAT Act. So it came from 1955. It's been around for quite some time. So when you die, then your assets go into an estate. What is an estate? So there is then a person that will manage your assets, because remember, you will be gone. Then, of course, we've got a person then who will be managing that estate, and then it's called the executor. So it's a person that will be acting like you, because at your absentia, then we'll have now to live in estate duty on the dutiable amount of that. After taking, of course, all the properties and deemed properties into account and abatement. So this makes up then the framework, for the calculation of of this amount. So we'll deal with that. So these are actually the specific, very important sections within this act that you should be aware of. You should actually go through, and possibly go through them today, but they're relevant for your knowledge. So who is liable for the estate duty? So estate duty is payable in respect of the estate of a person who dies. So if a person dies, there has to be estate duty payable. If it's an ordinary residence in the Republic at the time of death, on a worldwide basis. If it's me, I'm here. Every property I have worldwide will be taxed. If it's not a residence, only on South African assets. So as you can see, ordinary residence then you see is not defined, but you need to refer to case laws. One example is Cohen, where they versus the Commission for Inland Revenue, where the country to which a person would naturally and as a matter of course return from his wandering is considered as what? As ordinary residence. And two, where a person normally resides apart from temporary occasional absence. That's a Commission for Inland Revenue versus Kutel. So this is an overall framework of this estate duty. So you've got to deal with your properties. That's a section 3.1. Then these properties are valued as per section 5. Remember, you've got properties, then you've got deemed properties. So remember, guys, when you die, all your properties you have, you are actually assumed to have sold all these properties at market value. So you've got your properties and your deemed properties. Then you'll have your gross value of properties. Then you less deductions. Your deduction will be section 4. Then you less the net value of estate. Then you less the abatement and portable abatement. Then you have your dutiable amount of the estate. This is a very important framework, and you people need to please try real much to get familiar with this framework. Why am I saying so? Because I don't want a situation where you are confusing things. You've got to know what comes first and what doesn't. And when you calculate, for you to get the dutiable amount, you get it correctly. You've got to follow the framework. It's very, very important, ladies and gentlemen. So what constitutes an estate? Section 3 states that all the properties of a deceased person and any deemed properties of that person, they form an estate. When you die, all your properties will form an estate, okay? Then property defined, what is a property? They say, of course, property which did not exist as a real property at the time of death, did not belong to the deceased, but is deemed to be property. Remember, we talk about deemed properties. We talk about properties. This can be corporeal, incorporeal. We talk about deemed properties. You see, it didn't exist, but it's your deemed property. Property. Section 3 talks about any right that you have. And they actually say this right can be immovable or immovable. It can be corporeal or incorporeal. You see, but includes tangible or even intangible assets. It can be the right. Ownership of any other interest. For example, an right of occupation, fiduciary interest. Or when you talk about your bare dominion, and you talk about your fiduciary right, any right of even an annuity to receive an amount charged upon the person, even on a new amendment, they talk about if a person who dies after 30 October, contribution made by deceased to any retirement, which will allow this deduction in terms of paragraph 5, the second schedule. You see, yes, those rights actually form part of your properties. Your limited interest, for example, I'm not going to dwell much on these limited interests. We've just dealt with them now, but they are actually your rights. You see, they've got to be included in your estate. For example, if we talk about the use of right, a person holding a use of right has the right to receive all the income, but cannot sell the property. He cannot own the property. So the bare dominion means ownership without any other right. So the bare dominion in this case cannot use it, but can own the property. Fiduciary interest in this case is whereby a person, of course, if you leave a property to another, meaning which that property has to be valued. What is excluded from property? This is important now. What is excluded from property? Why this is important? Because a question can just come. I don't want all you people to dump everything into property. You've got to understand what is not property. For example, retirement benefits, your lump sum received as a result of death are not included in property. Exclusion also, if you are not a resident of the Republic, you see, yes, on the date of death, also any right in immovable property situated outside South Africa, any right in immovable property physical situated outside South Africa, any debt amount recoverable in terms of courts, and also any goodwill, license, patent, design, trademark, copyright, or other similar right not registered in South Africa. Any stock or shares in board corporate that is not company as defined, and any stock or shares in company where change of ownership of such stock is not required to be registered in South Africa, and any right to income, produce, or proceeds derived from property referred to in the pub. So what is a deemed property? We look at that. We just dealt with properties now. So your 3A, so the domestic policy of insurance, for example, we should have to be valued at full amount, you less any premiums that have been paid and interest on that of 6%. This can come up in a test. I mean, like really, it's quite a straightforward calculation that I would assume you people, to be cruising, to know. Yes. If you are married in common of property and surviving spouse is the beneficiary, only half of the premiums then will be deducted. Deemed property is also your domestic policies. In case of deceased, your insurance policy proceeds excluded from deemed property. Also, the policy recovered by surviving spouse or a child of a deceased surviving spouse in a post-nuptial contract saying a person has a right to it. Or even a policy taken by a partner or a co-shareholder, if in a company, to pay premium, and the purpose of the policy was to establish such other person to acquire all the part of deceased interest in an entity. Say, for example, I've got a partner, I'm running a company with a partner. So I'm saying, well, let's take a policy that if you die, I will be able to I'll be able to use the policy to buy the interest you have in the company. If we take that policy, then it means, that policy is not a deemed property of a person who dies. If a policy condition is certified was not affected by the status of the deceased, then no premium was paid by the deceased, then no amount will be paid also in the estate of a deceased. That's the principle. Your deemed property also, property donated by deceased where such donation was exempt. You see, under specific exemptions. Then also in terms of, as you can see, we talk about D or C. What does C mean? C, that's anticipation of death, contemplation of death. Your D is actually in case when a donor dies. Also, the donation amount occurs in respect of, in terms of the Income Tax Act, or a donation under which a benefit only passes to the donor on the death. That's of 16. Then also, if it's valued, for example, we've got Mr. A donates his farm to his son, but his son only gets the farm when the Mr. A dies, you see. Also, when no donation tax as an exempt of, which was exempt, so the farm then is not Mr. A's actual property. When he dies, his transfer was then passed to his son. This is also one of the things. It's not actually a deemed property in that regard. So your 33 then C capital A is accruals under Matrimonial Property Act. So This refers to a scenario where the deceased estate has a claim against a surviving spouse or the estate of such spouse under accrual system of the matrimonial or divorce or death. So this is where now you get married. So at some point, people, they love each other so much that they want to stay forever, which is fine. But sometimes they may divorce. So if you've got now those antenuptial contract, postnuptial contract, and they apply, you see this can also actually apply this section. So spouse with no accrual, small accrual acquires a claim against the other spouse equal to the half of the spouse. So sometimes you find out that this other spouse does not have, has less, than another spouse. Then that spouse, then in that case, has the claim against another spouse. Okay, we've got a question here. So in this question, actually, it's an example. We've got Mr. and Mrs. Split. Oh, wow. What even that name? Look at that name, Mr. Split. So we're married out content of property subject to accrual system. At the date of marriage, Mr. Split assets were 100,000 and Mrs. Split assets were worth name. On 1st June 2014, when Mr. Split passed away, the assets were as follows. Now, as you can see, Mr. Split only has 2 million, but Mrs. Split has 2 times the assets of what? Of Mr. Split on the death. Assume that the value of Mrs. Split assets, which he brought into marriage, had increased to 300,000. Now you can see. So it means out of the 2 million, his worth of 100,000 is increased to 200,000. Therefore, increase of Mr. Split's estate, which is 1.7, and the Mr. Split's estate grew by 4 million. Now we've got 1.7 million for Mr. Split and 4 million for Mr. Split. Now it means Mr. Split has the claim over the estate of Mrs. Split. The difference between these two will be 2.3. So Mrs. Split has the larger accruals. Therefore, Mrs. Split assets has a claim against Mrs. Split to the half of what? Of that 2.5 million. This happens because they had actually they were married outcome to property, however, within a accrual system. Meaning whatever they accrue within the marriage, then they share within each other. Even though whatever they came with, they will not share. Deemed property, which then in this case, the property which the deceased was committed to dispose. If you are deemed to have been committed to dispose at the time of death, then that's a deemed property. Where, for example, the deceased was in position to dispose property immediately prior to his death. That's why they say you are deemed to have disposed your property immediately before death, even if you don't sell them. See, of course, then your property will include anything, but as long as you are deemed to have been in a position to sell it. For example, if a deceased was a sole trustee of a trust, as well as beneficiary, he had the power to dispose the trust property to his own benefit. Therefore, the property is deemed property in his estate, even if he did not exercise that, because remember he was both the trustee and also the beneficiary. So this does not include property already included. Of course, you cannot be taxed twice. Also does not include shares of this spouse in the joint estate. So the valuation of properties. So you will have to value properties. So you will mostly be given a lot of things. For example, your use of rag will be given, your bedroom, and all these things. But when it's deemed donation, you need to know those things. So valuation of property. How do you value the property? So the property then we actually use, through bona fide purchase. So for example, see, it will be valued at price realized by the sale in cases of liquidation. But in unquoted shares, it doesn't apply. So the cost of liquidation, then the Commissioner versus SARS, there was actually a case that where they said that the sale must bear some relation to liquidations of the estate, then should be a sale by a executor in his capacity as a executor and not in the capacity as the beneficiary. So if we've got an executor that is related, they should sell as executor, not as the beneficiary. So property then not sold in any other property which does not fall into the specific valuation, then it should be valued at fair market value as per 51G. So as for the unquoted shares, then even if sold at a different price, so there may be restrictions which are contained in a memorandum. All those things must be disregarded. If the deceased has the power to confer benefit on himself in respect of assets, then through the shareholders, then these benefits must be taken into account when the shares are also valued. But your section 5.5 states that the term shares includes also any member's interest, meaning which if it's a close corporation and all that. Then the donation then will be included also, I mean, in the property, in the deemed properties at fair market value. For the unlisted shares, which company which owns property in which farming operations, we did say this, you always use what? 30 and 70% inclusion rate. So we've got these provisions, the provisions here, when you deal with the usufruct. So if the beneficiary of the limited right originally purchased the bare dominion in the property, deduct the cost of the bare dominion plus interest 6%. It's very important. We've got an example of here of Mr. A. He sells the bare dominion in his farm to B for 80,000 and gives C the usufruct over the farm. So 5 years later, C dies at a date which the usufruct has a value of 1.3, calculated equitable amount. So we'll have the value of usufruct is given, then reduced by, you reduce it by 6%. This is in respect of the provisions. What does this mean? You deduct the cost of the bare dominion plus interest. That's what you do. So the cost of the bare dominion is 80,000, then the interest of 6% for 5 years. Then you got now the value of usufruct. So, but these provisions, they are not likely to apply to you people. Why? Because you see, as much as these sections are considered relevant, but not really at advanced level, yes, but you need to know about them. So if no debt of the deceased, the bare dominion holder gets full ownership of the property, the value of usufruct accruing to him of estate cannot exceed the fair value of the property at that time. We've got an example here of Mr. A donates the usufruct on a farm with a fair market value of 1 million to B and the bare dominion to C. At the date, B was 60 years old and the usufruct at a value of 700,000. The bare dominion has 200,000. You can see the difference there. It might be getting to 1 million. In year 10, B dies and C gets full ownership of the farm, which is a fair market value of 2 million. Now, can you see the fair market value of a farm is 2 million? However, the usufruct value in this case is 1.9. So the amount is included in B's equitable amount. So in this case, you'll have the usufruct value of 1.9, then it will have to be limited to 1.7, which is 2 million less 204,000, which is the value of the bare dominion. Yes. But you can see we're actually deducting it from what? From 2 million. So these provisions then only applies if the bare dominion was acquired, of course, under the same transaction that created the usufruct. So it should not be different. Your provision number 3, if the new usufruct cannot be determined until some future date for the unborn heirs, then you use the 50 table. But you don't have to worry about this table, you people, because it's not something you have to worry about. Usually relate to, of course, annuities. Sometimes when you've got your valuation of annuities not charged against property. So what if a person dies receiving the annuity will either cease or maybe accrue to another person. So if the annuity then cease, it will not fall into the property of a person, but will be transferred. Because remember, it will now cease to exist and to another person. But if it carries on, then we'll have to know. But it's actually based on life expectancy of a person. So it's what I say, you should not worry about the calculation of the life expectancy. But for example, then it must be valued over the life expectancy of a person receiving the annuity. Then provided that within 5 years of the annuity cease, either due to death, you don't also have to worry about that. So what happens to the valuation of the property? So in this case, will take effect on the debt. So you need to refer to donation mode causa, so where under which the benefit only passes to a donor on the death of the donor. Remember, we said we've got specific exemptions for that. For example, your 56 and 56D. But such donation are deemed properties also will be included in terms of the Estate Duty Act. So they need to be valued then for the purposes of this section, and we need to know what is their value. And also they will be valued at fair market value the date the donation takes effect. So sometimes then you've got your deemed properties which ceased. You see, in this case, then you'll have, if the property that are valued at annual value, you'll have to use a capitalized value of 12% over the life expectancy of a deceased. But you don't have to worry about this 12% life expectancy of deceased and all that. So, for example, we've got valuation of property here. Then for the purpose of section 5B, then for the purpose of determining the section 4, then the annual value of right of enjoyment of property is determined to be 12%. So in this case, for example, as you can see here, you'll have to talk about the period that the property will be used, but you don't have guys to worry about these calculations. Yes. Then we go to less deductions. So we've dealt with property. We're saying when you're calculating the equitable amount, you've got to know the property. You've got to include the deemed properties. Then you've got your gross value. Then after that, you less your deductions. That's your section 4. Then after that, you do net value. So let's go to section 4. So section 4 then deals with all the allowable deductions. For example, your A, the death, tombstone, and funeral expenses will be allowed. But they are very specific. They are saying you cannot slaughter a cow. If then you are from my culture where we say, oh, it is a death of it is actually the death of an honorable man. We want to slaughter a cow. It will not be allowed. Also, the debt due to the republic. Remember, sometimes you still owe SARS. When you die, guys, you might be owing SARS. That debt will have to be deducted. This also excludes any claims, of course, by a person for the property donated to them. Remember, sometimes there's a property that is donated to a person. See, yes, when you die, so it will be excluded. Sometimes also there is a bare dominion that you donated, it will also be excluded. Your 4C deals with administration and liquidation charges. So this would actually also be what actually deducted under 4C. Also, you've got your D expenditure necessary for complying with the Act. If there is any cost which is actually necessary and actually incurred by the executor, they may, deduct that. Your section 4 debts due to outside the Republic only to the extent that exceeds the value of foreign assets, they will also be deducted. Your 4G, which deals with the value of usufruct, the value of, all those annuities and paid will also have to be deducted. So section 4 then H, where if you donate something to, sometimes there is, donation to charities, and other bequests, which is left to public benefit organizations. So if they carry public benefits, of course, within South Africa, then in that case also they will be allowed. So in case of an increase in value, which result from improvements made by the beneficiary. Sometimes, let's say there is my son is a beneficiary of my property now. My son then effects improvements to that property. So it means now then those deductions will be allowed. An increase also in value of usufruct or interest will also be allowed, and also any claim by surviving spouse in respect of accrual under Section 3 of Matrimonial Act. You remember we dealt with Mr. Split and Mrs. Split, that will also be allowed here. Your 4M, a usufruct or right to annuity charged upon a property, it will also be allowed. And also, but you need to know, provided that it was included in procedures as spouse estate in the Section 4Q. That's one of the requirements. Your 4O, then the value of books, sometimes pictures, will also be allowed. Your 4P, the value of deemed properties, take into account the valuation of shares, for example, to the extent that it was effectively included twice, it cannot be included twice. Your 4Q, the property left to the surviving spouse, to the extent that it is not already deducted under any act, it will also be exempt. But you should know that these deductions, of course, must be reduced by the amount that surviving spouse has to dispose in other person, in respect, of course, if it will be deceased. So deductions then under this section cannot be claimed in any property, of course, accruing to the trust or the surviving spouse. That's very important. Then we go to the abatement. That's very, very important. So every natural person actually has the abatement of 3.5 million. That's your primary abatement. Then with your spouse, it goes to 7 million. Now, where a deceased has more than one spouse, so the 7 million, of course, can be reduced. Yes. Where if you are a guy that, that can manage coalition, you are a polygamist, you can have more than one wife, then your 3.5 can be divided. We go to a situation whereby we've got a primary abatement of 2.5, then sometimes any portable abatement. This will be divided between the spouses of the deceased spouse. Say, for example, I'll give example of Mr. X, utilize 1 million of his primary abatement. So if, for example, the assets that I have as a person can only relate to 1 million, it means I can only utilize 1 million. This is what happens to Mr. K. So he still has 2.5 million left for him. Then it will be divided according to what? For his wives. As you can see, divided amongst the 3 wives, then each wife now will have their own 3.5 plus this one. So the abatement and the portable abatement relates to in case you've got a spouse and you are married, then it can go to your spouse. So your 4, capital A4, the amount then will be reduced in terms of 4A, on also reduction of an amount of abatement is used by the state of a person cannot exceed 3.5, meaning which if you've got your own 3.5 and another 3.5 for your spouse, if it wasn't used, you've got all 7 million, which is a support. The portable abatement also cannot be claimed unless the executor of the later dying spouse. So we need to know there was a copy of the submission. The commissioner is aware of the first spouse. If the spouse dies at the first time, the spouse with the smaller estate is deemed to have died first. Imagine. Then you've got your 16 deductions, so which is allowed against an estate guilty payable. So if a property is secured outside the Republic, then it will be subject to foreign debt, and sometimes you'll have to reduce now the sufficient state duty by the lesser of that. So this is then deals with the person liable for the estate, who is liable in respect of the Section 11 of the Estate Duty Act. So you can see in this case, if it's a fiduciary or usufructuary or like interest, then the beneficiary is liable. And also if it's an annuity which accrues to some other than person on the debt, it's a beneficiary. Also, if it is an amount due under domestic insurance, the person that whom the payment is made to. Then if it's a donation in motia causa, then the donee, they are liable. Then in all other cases, the executor. Now, what happens to the payment of estate duty? So Section 13 then state that the total duty must be paid by the executor. This is a person now, remember, when you are gone now, we've got a person that takes over. I've been saying that. So this person then must make sure that they pay. So if they didn't 2-to-1, then they make an apportionment to that. For the purpose of the section, then it must be apportioned between the person liable for the duty. We need to know who is liable exactly. So your section 15, recovery of duty is paid in certain cases. So where for is donation motia causa, under which the benefit only passes to a donor on the death of a donor. Sometimes if the donor has disposed of a property which is less than the full consideration, then it can be claimed. Also, Section 10 then deal with expenditure incurred by the executor. So if the executor themselves, they incur some expenditures, they'll have to, to be paid. So executor may recover expenses incurred from the person liable for the executor in case there is no equitable amount. So what is the rate? As I said, people, it's like donations tax. If your value is less than 30 million, is 20%. If your value is more than that, is 25%. All right, guys, thanks very much for attending the session. So someone just once said, I just filled out my income tax forms, who says you can't get killed by the plagues. So you can actually get killed by the plagues. All right, guys, thank you very much for attending the session today. Let me just go back. Then yes, then guys, this case, okay.